The Great Depression in the early 20th century United States has long fascinated economists and historians alike, sparking extensive debate about its causes. Despite agreement on the major economic events of the era, specific fluctuations within the Depression remain somewhat underexplored, largely due to the focus on aggregate interpretations that align with modern macroeconomic modeling. The Great Depression began following a significant stock market crash, which initiated a panic sell-off of assets. This, in turn, led to deflation in asset and commodity prices, dramatic declines in demand, and the total money supply in the economy. As trade was disrupted, these factors culminated in massive unemployment and widespread impoverishment, with over 13 million Americans without jobs by 1932. Nevertheless, the specific causal relationships between these events and government policies remain heavily debated. Two primary mainstream theories currently dominate the discourse. Demand-driven theories, chiefly advocated by Keynesian and institutional economists, suggest that the Depression stemmed from a pervasive loss of confidence, plummeting investment, and persistent underconsumption. They argue that the financial upheaval after the 1929 crash resulted in significant reductions in consumption and investment spending, as investors sought to minimize losses by hoarding money during a deflationary period, thereby exacerbating the demand drop. Conversely, monetarists contend that the Depression, initially a regular recession, spiraled in severity due to critical monetary policy errors by authorities, particularly the Federal Reserve. They argue that these mistakes caused a sharp contraction in the money supply, which transformed an economic downturn into a protracted recession. Beyond these mainstream views, alternative explanations further enrich the discussion. The Austrian school posits that the Depression represented an unavoidable correction after an unsustainable, credit-fueled boom in the 1920s, with policy interventions only prolonging the crisis. Meanwhile, real business cycle theorists and some new classical macroeconomists highlight supply-side shocks, wage and price inflexibilities, and institutional factors like labor market policies as central to understanding both the causes and severity of the Great Depression. Together, these varied perspectives contribute to a more complex and nuanced understanding of one of history's greatest economic calamities.